Hey guys, welcome back to the channel. Today I want to cover the question, and I'm revisiting Curve Invest. Are they yield mid? And this is a play on YieldMax, the company, because they're competitors. So I would say that since my initial video on covering Curve, like I wasn't too thrilled with them, but now I think they've made some improvements since that video. So I want to be fair to them. So let's get into it. So Kurv has been busy lately. I was wondering if they can actually snatch the crown away from YieldMax, because they've done they've made some improvements. Um, like in my last video, I think I was a little too harsh on them because I had just kind of nitpicking on like the name, Y Curve instead of just putting like these ETFs under like the Neos name. That's not a big deal, I guess. But I guess like the main concern I still have with them is that they still have a kind of like a gimmick fee. Uh, you know, like originally it's supposed to be 115 basis points, but I guess like for like about a year or so, they're gonna keep it to 99 basis points. I think they should just get rid of that and just either keep it at 99 basis points, or maybe like if they want to take away market share, just slash like the expense ratio down to like 75 basis points or something, because they probably have some momentum here. Okay, so like the strategies are basically similar. So they have synthetic longs and then they sell covered calls on these synthetic longs. So it's very similar. The only difference that I would note is that like just like based on how they have like their strikes. So I know that they're a little bit more conservative than YieldMax, but we'll see that in the returns coming up. So one of the things that I was happy to see is that they actually have a end of month payable, and this works out for I think a lot of people, because let's say you like one of their ETFs, and you kind of want to avoid having like all your payments in like the same week. So like for example, like Defiance, they have like their payables closer to the beginning of the month. YieldMax has theirs like kind of in the middle. So this is good from both a marketing and competitive standpoint, because now that you have like these ETFs, like kind of like this is like their turf. So like if you pay like kind of closer to like the end of the month, I think that works well. So this way they don't have to even compete directly on YieldMax in terms of payment dates. So I this is a part that I like. And now let's just get down to it. So there's like 6 ETFs so far. And then there's like a few more that should be coming soon. So what I did was I just went to the website. I picked up their dividends and like I guess like the most recent price. And then this is based off of November 24th data. So just like I just did a quick calculation on like the for the month of November, like the yield, and then I kind of extrapolated that and just multiplied everything by 12 just to get an estimate of what the full year yield could look like. Of course, like since we're like the market's been going up, so the yields are probably going to go down, just because like there's less option premium to sell. So either they have to like bring their strikes a little bit closer to get more yield, or they can just keep it the way that things are, um, and allow for I guess a potential capital appreciation on like the synthetic longs. So, but they'll probably keep it more conservative, is my guess. So their overall yields should be a little bit lower than YieldMax. And that's not actually a bad thing. I guess like it depends on how they want to like compete. If they do a head to head, I don't think it makes much sense. But if you keep like the yield a little bit lower, but keep like your share price like kind of roughly the same, or actually allow it to go up, I think that's a good thing. It helps differentiate like their products. So I think overall, they're doing a good job so far. The yields might be a little bit skimpy for some people, but these you gotta be realistic. I think these are pretty good, considering like this is still new. So I think this is they're hopefully they'll keep up this progress. So there's three more ETFs coming soon. I looked this up on like Morningstar.com, so you can probably just do the same just to confirm for yourself. So they should have also a ExxonMobil, a JP Morgan, and a Disney fund coming up soon too. These three, probably won't be that exciting, but it's really good to see because they're fleshing out like their product offerings. So if you notice, most of these have like a corresponding YieldMax opponent, so to speak. So I think like this could be really good for for us like the investors because like especially if they go into like a maybe like a expense ratio uh like a bidding war, well hopefully on the way down, just to capture like more market share from each other. I think this is overall like a good thing for the space. So like just to sum up, I think competition is just generally good for the space. I'm kind of hoping others will kind of jump in, but with like maybe like different products, I think that could be also a good thing. So far, like the curve, they've kept their share prices consistent or actually improved upon them. Uh, but we'll see how they go as the months roll on. I think this is generally like a positive thing for the space. So, but again, like with anything else, don't put everything like into like any one company. But I'm glad like there's like choices now. So like if you don't, I guess like if you're more conservative, I think Curve could be like another option for us. Of course, like it's always good to have like other things too, like even just like regular treasuries or dividend aristocrats. I think that'll be a good thing. And then just overall risk. The expense ratio, I think, again, can be improved. Uh, we don't have any control over option strike selection, but now we can choose between like the different ETF companies, and kind of compare like how like if you want something more conservative or like if you want something more aggressive. Now we have that choice. But like the overall implied volatility, uh, there's not much like any ETF company can do. So if they collapse, like the yields for everybody will just go down potentially. And of course, like they're so far like they've kept their share price pretty good, at the same or higher. But of course, like they can always go lower if they're not careful. And of course, like yields won't be consistent month to month. And because they're new, we won't be able to borrow against them yet. So there's always like a yield trade-off. So, but now there's choices. So now we can kind of pick and choose. If you like this type of content, please consider giving it a like and subscribe. Thank you everyone so far. That's been leaving positive like comments, subscribing, watching. That really helps me out, and also helps like the just like the little guy investors to get like this information out there. Because I really think it's important. So thank you once again, and I hope you have a great one, and I hope you guys make money out there. And I'll see you in the next video. Bye now.